Well, we're down. Three of our advisors are out today, so I was kind of the last guy on the bench, I think. But that's all right. I'll still accept it. So most of you probably know our Compass team, but in case you don't, back here is Joe Waniger. Caleb Pearson is helping with the sound and the technical stuff. Steve Connard is right here in the center. Nancy Economist, Cheryl Hurst back by the food there, Hannah Mason, Julie Greer, and Alan Holstein. And so if you, one of the nice things about coming in person to some of these, and we have several joining us virtually, is you get to maybe put a face with a name. So hopefully that helps. So when you have a service question or you need to set an appointment or whatever, you can do that. Well, I know one of the topics in the presentation today is inflation. Our inflation index reading just came out. Was that yesterday? And says that inflation moderated some again in June. I want to hear from your practical experience. What do you think? Is inflation beginning to taper? We all know gas prices are down from their highs, so that helps. What about inflation in other areas? Are you still feeling it in your life? Do you still notice it at the store? Things are, yeah. Yeah, I read an article in the journal that indicated that a lot of the materials in the grocery store, a lot of the food items around the edges of the store have come back down a little bit from their highs, but the prepackaged processed foods that are in the center are still climbing. And so that was an interesting perspective to take note of. But so also read an article about our gas prices coming back down. The production of oil in the Permian Basin is back on track to hit an all-time high because of oil per barrel, the price of oil per barrel moderating, so that they can kick back in some of that. So that should maybe help our gasoline prices for the foreseeable future. I don't know. We'll see, I guess. So other general economic perspectives locally. What's everyone's sense of the real estate market here mid-year 2023? The real estate market here in Des Moines, central Iowa. Are houses selling fast? Are they taking a long time to sell? I think the interest rate hike is slowing things down. Does anybody have an anecdotal story? Yes, Karen. Mm-hmm. Yeah. Yeah. Okay. Yeah. Some out-of-state investors coming in. If you couldn't hear that comment, that's interesting. Well, maybe you saw on KCCI, there is a nice home for sale right out west here off Jordan Creek Parkway. Jeremy Hellickson and his wife are selling their, what, 5 million or something. So I'm not a real estate agent, but I'm sure someone could hook you up if you're interested in something like that. They need something bigger, I think the article said. So yeah, good for them. All right. Yeah, that's a good perspective. We're still some of the things that we learned during the pandemic, right, about working remotely are still having some shock waves, especially in the commercial real estate market. A little bit shielded here in Des Moines, but I read quite a bit about what's happening on each coast. And boy, in those markets, there are a lot of buildings sitting empty and some commercial real estate downturn seems imminent in those markets, especially. And we'll see what happens here in Des Moines, but sometimes it takes a little bit longer to hit us here in the Midwest. So yeah, with that, I think I'll turn it over to someone that is prepared or almost prepared. First Trust is a group that we've been following for several years, and we really like the comments of their lead economist. He comes out with some comments weekly, and seems to really I don't know, bring things to a very real level. Sometimes economists can keep things, really high eyebrow. And so Westbury is his name, and we enjoy his commentary and think it's pretty real and spot on. So Corey, are you ready?
Yeah, it's linking up right now.
Okay.
So we'll give it about 2 more seconds here.
Okay. I heard you were coming from Oskaloosa.
Yep. So yeah, originally from Iowa City and then drove to Oskaloosa this morning for a couple appointments and then here.
Mm-hmm.
So yeah, it's been a quick trip. I've got 3 kids under the age of 6, so it keeps me pretty scatterbrained. But now I've got. You want to just do that? Yeah. Okay, perfect. I'll use the.
You can just use that mic. That's fine.
Yeah, perfect.
Please welcome Corey from First Trust.
Thank you very much. Appreciate it, guys. So yeah, it keeps you pretty busy, right? I mean, I've been through the college years. I've got a stepdaughter who's 25, so out of college. Is hopefully going to be married here pretty soon. Sounds like they're getting engaged. Pretty exciting. But then my poor wife decided to start all over. We have 3 kids now, and 3 kids under the age of 6. So you can imagine that you get a kid out in college, empty nester for about 6 months, and then that poor lady decides to start all over with me. She picked the wrong guy, I guess. But we're going to get started here in just a second once we get the presentation up. But just to give you a little bit of background with First Trust, one of the things you heard from Compass here is we partner up with them in a way where we provide a lot of economic research and information. And there's a gentleman by the name of Brian Westbury that you just heard about that is really kind of the face and the name to what First Trust does, because we don't have any advertising. Very large firm. We're actually 3rd in the country in ETFs, exchange traded funds, if you've seen any of those in your portfolios before in the past. And one of the things that he's been really good about is what he calls the antidote to conventional wisdom, right? You hear sort of the talking heads on TV. And what's interesting about these, because he used to have contracts on TV, CNBC, whatever it happens to be. And what you'll notice with CNBC, especially back in 08, 09, they would bring on like 20 different people at the same time, right? They'd have the little boxes, right? It's almost like if you ever watched the Brady Bunch, they'd have the little boxes, but it was like the Brady Bunch on crack, right? It was that kind of thing because they're all yelling and screaming at each other. But it was really everyone kind of had a similar viewpoint, but they bring on people to have conflict, to have discussions. So our economists would get on and they would tell them, hey, we don't want you on today. You're too bearish. We're going to bring on a bunch of bullish people today. It's sort of interesting how that dynamic works. But what I want to focus on today a little bit with you is inflation, rising rates, and volatility, all things that I think jump out. Well, the main thing I want to do is give you perspective. Because with that comment I made about Brady Bunch on crack, right? If you watch CNBC, if you're on social media, any of those types of things, we get information almost immediately these days, correct? And so we're almost like designed to be traders at this point, but we have a hard time taking a step back. Clearly, CNBC and a lot of those news sources have a difficult time taking a step back. So if you can flip the slide, or do you just have a clicker? Or do you want to do it for me? Okay. So does anybody know who this is up on the screen. You guys recognize him? Who is he? Matthew Stafford. So you all know that a couple years ago, he won the Super Bowl, right? With LA, with the Rams. But that was his first year with the Rams. Does anybody know where he spent the previous 12 years of his career by chance? Detroit Lions, right? Can you imagine being a Detroit Lions fan? You've got a championship quarterback on your team and you can't win a playoff game the whole 12 years he's there. And then the first year he leaves, goes to the Rams, wins the national title, right? Wins the World Series or the Super Bowl, excuse me. If you flip to the next page, you'll notice that that doesn't keep fans like that down. They still hung a banner. It says the old QB won Super Bowl, right? Back in 2021, 2022. Talk about being optimistic, right? And have a good point of view. It's a difficult town to win some sports in. So I make a joke of this a little bit because, again, we have a hard time taking a step back. So if you don't mind popping to the next slide here, sort of difficult to see. I'm going to read off a couple of these things to you here. But what you're going to notice is that this is the market since back in the 70s. And what you'll see is that the blue line here is the returns on the S&P 500 over that period of time. Now, all these little dashes up here, right? Everything from Nixon going to the gold standard or ISIS, the oil spill we saw a handful of years back, COVID crisis. These are all kind of the negative, major negative events that have occurred over that period of time. And if you look back and you think back at all these different events, you think to yourself, how in the heck is the market up, right? It's pretty incredible that we've been that resilient. It always takes me back to a quote from Warren Buffett. He would always say, and he still says today, if you bet against the US, you tend to lose, right? That's kind of the case right now. It's sort of the case, I think a lot of folks that are kind of looking at treasuries and things like that as kind of playing a little bit of defense. We certainly think there could be some volatility come up. We'll talk more about that in a second. However, long term, it's difficult not to be vested for as long as you can, because again, if you're investing in the US, you tend to win. If you flip to the next page, I'm going to go through a little bit of economic data with you, and we're going to go into some more interesting points here. But just to put GDP in perspective, remember GDP, gross domestic product, this is just all the stuff that we create here in the US. And you'll notice we saw the dip back in 2008, 2009. It seemed pretty dramatic. We went from about 16 trillion to about 15 trillion during that period of time. And then of course we got to the 2020 timeframe and we completely shut the economy down, right? Pretty incredible. And we dropped from that 19 range all the way down to 17. But you'll notice those two quarters were two of the worst quarters in US history from a GDP perspective, right? Because when you shut things down, you're not making anything, obviously you're going to see a pretty big drop. But what's interesting is over the next couple quarters, we actually got right back to even. And you'll notice now we're close to 20 trillion in total GDP, right? Above where we were pre-pandemic. It's sort of interesting to see that. But with all the negative news out there, sometimes it doesn't always feel like that. Flip to the next one there, Caleb. You're going to see that this is the cost of debt. One of the things I get a lot recently is, Corey, have you seen how much debt that we've got right now? I mean, the Fed seems like they're just, government seems like they're spending an enormous amount of money, which is absolutely true. But I think we focus on the wrong things. It has less to do with the amount of debt that we've got on the balance sheet. It has more to do with what is the cost to service that debt, right? It's not necessarily the size of the mortgage you've got, right? It's how much it costs to service that mortgage, right? We have balloon loans and costs are going up, interest rates are going up. All of a sudden that same size house costs a lot more. And eventually that's going to be an issue for the Fed as we keep rates higher and higher. However, what you're seeing here is the percentage of GDP that it costs us to service our debt, okay? And we're right at about 1.5%. Now, remember, debt rolls off really slowly from 10 years ago, 15 years ago, 20 years ago. And as that debt continues to roll off, it's going to be refinanced at higher and higher rates. But that takes time. You see this back in the 70s and early 80s, right? We went from that same kind of 1.5, 1.25 range, and we got up to 3%. That's where the troubles start to come in, 3%, because we're producing in that 1.5, 2% historical range in GDP. So you start getting that 3% range, and all of a sudden, we're not making enough stuff to service that debt. That's where the politicians no longer can kick the can down the road, and all of a sudden, they have to attack the issue. They have to bring debt down. But until we start working their way back up there, you probably won't see politicians focus on the debt all too much, even though that's accelerating quite a bit. But for now, at least over the next 5 to 6 years, currently shouldn't have to worry about it too much, but those costs are rising. One more page. We're going to talk a little bit about inflation because this is a difficult concept to kind of get, I think. At least it was for me early on in my studies. This will give you kind of an idea here in the gray color. This is the Federal Reserve. So the Bank of Japan is in orange, and then the European Central Bank is in blue. This will give you a pretty good idea during that kind of 08, 09 timeframe. We were sitting, pretty low balance sheet. This is the amount of paper the Fed prints. And you'll notice we went from basically 1 trillion to 2 trillion. We doubled pretty quickly. There's a number of dollars that the Fed prints, right? Think of it that way, okay? So they doubled their balance sheet up to 2 trillion. And then you'll notice slowly but surely over that 08 through about 2018, 2019 period, it just steadily moved up. It continued to spend money, right? Continued to print dollars. But then you see this huge jump back in 2020, right? We go from basically 4 trillion and we're close to about 10 trillion right now in debt. So what does that mean? The Fed actually goes out and prints dollars. Here's an interesting fact. 45% of all dollars in existence today was printed in the last 2.5 years. Incredible, right? That's what that is. That's what this chart is showing us, right? That has an effect. Short term, what that does is props the economy up, gets us to spend more, right? Saves us from a shutdown like we had during COVID. But there's always an effect to that, and that's inflation, right? Price of goods and services have all gone up. We've experienced that over the last couple of years. So next slide there. So what you're going to notice here, this is just money market funds. You'll see the big giant spike in 19 and 20, right? We went from about 3 trillion in money market funds up to close to 4.7, 4.8 trillion we've got right now in money markets. People are resistant to spend some of that because the cost of borrowing is high. Your RV, the new car, whatever it is extremely expensive. So we're kind of holding off to a certain extent. But what happens is when the Fed drops the rate, right, the lending rate down to 0.25 from the 5% plus we've got right now, when that occurs, that's when all the cash starts coming back in because money becomes very inexpensive and we can grow those assets. Next slide, if you mind. So what happens, again, we see inflation jump up to 8.5%. If you want to flip to the next slide, you'll see here's what this actually means. Let's go back to that GDP, the amount of stuff that we create in the economy, right? Well, to buy that stuff, we use individual dollars. So let's say there's 10 total dollars in the entire system right now, okay? Very simple. Go ahead and click to the next one. And we're also the number of stuff that we create here. Let's say there's 10 total apples, okay? So how much does each apple cost if there's $10 and there's 10 apples? $1, exactly. Each apple costs $1. One more time. There you go. One more time, if you wouldn't mind. Now, let's say the Fed comes in and prints more dollars. Now we have 3 more dollars, right? A 30% increase. So one more time. Same number of apples, 10 apples. Now how much is each dollar worth? $1.30, right? This is how money affects goods and increases the cost. Now, one more time. Then you throw in the pandemic and the supply chain crunch, right? The number of stuff that we're creating goes down. So go ahead and click forward. What you're going to see here is the largest port in the U.S., Los Angeles and Long Beach port. This is the container ships that are coming in and out of port during this time frame, right? October 15, 2019, it goes by hour. There's about 4 to 5 at port at any given time. There's maybe 1 ship out at port waiting to get in, okay? Click one more time. You'll see October 11th, 1 year later, that's what that same port looked like, right? You see now we've got about 10 or so ships at port. They shoved every ship in there they can, plus another 20 or so that are anchored outside, and then another 15 to 20 that are doing some crazy patterns outside of this, right? The reason we couldn't get toilet paper isn't because the toilet paper wasn't coming in. It's because they couldn't unload the container ships fast enough and ship it to the warehouses. My dad's in the shipping industry, and he said the warehouses were full of toilet paper. We couldn't get it to the stores. There's nobody to drive the trucks. We couldn't get it out of the container ships. That was the challenge. So click one more time. This time we've got that same 3 more dollars, but now we cut the number of apples in half, right? Because we're not producing as much. Now how much is each apple worth? $2.60. Welcome to inflation on both sides, right? So as we continue to repair the supply chain, getting back to 10 apples, you'll notice inflation is still in. We still have that $1.30, right? even as we drop. That's what we're digesting right now. So think of it this way. When you print $45 more, it's almost like a python trying to digest a pig, right? It takes years to do that. Pretty incredible. That's what we're going through right now. When you print 45% more dollars, it takes a long time to digest all of those dollars, right? Which is why you're seeing wages go up, powers back in labor unions, and so on and so forth. You'll see more of that later on. Go ahead. So let's touch on the markets with you real quick. There's lots of ways to invest, but how does high inflation sort of affect different broad areas of the market? And this is one of the reasons why your team at Compass have nice diversification in here, is because bonds maybe suffer a little bit. That's why you're seeing some alternatives with them as well. Gold tips are kind of flat. Stocks do relatively well, depending on where we're at. You've seen that the last year and a half or so. Certain sectors have done well and others haven't. One area that people don't talk nearly as much about, though, is the hard asset space, right? We want to know with property, plant, and equipment, we know exactly the kinds of returns we're getting out of that versus more the virtual growthy type assets, right? With AI, is AI going to pay off? Probably. How much? I don't know. Which companies are going to benefit? I don't know. It's to be seen, right? That growth rate is a little harder to come by. We know from the more value assets that we can get more return if inflation does in fact stay higher for longer. Go ahead, click one more time for me, Caleb. So the challenge is you see guys like this, right? Anybody know who this is? Jim Cramer, right? So speaking of CNBC, I don't know if we have sound. If we don't worry. You're going to see the words up on the screen here. Well, I think it's fascinating about this. If you go back to 2002 last year, most of the analysts were still really big in all those big tech stocks as an example, all the growth stuff. So you can see 261, he's saying, we still love NVIDIA at 261, right? All the way down, we're going to keep adding to it. I'm not saying NVIDIA today. I'm saying that don't write NVIDIA off. In the last month, NVIDIA down 130. He's like, NVIDIA's a loser. We're shorting it. Let's get out, right? It dropped, what, like 80% by then? I mean, this is just a sort of funny way to show you it's difficult to even be an analyst in this business, right? They're always sort of chasing where the returns come from. This is where diversification comes in. We don't know what's going to shift and when, but just because every analyst is on one particular stock or a group of stocks doesn't mean that's where you should be investing all your money, because we see that a lot right now, a lot of euphoria at the moment, right? Around a very small basket of stocks. Diversification, I think, does a little bit better job. So going back to 2002, the Super Bowl, what you're seeing here on the screen, Uber Eats, DraftKings, Carvana, FTX, you probably recognize that name, right? Coinbase, these were the largest sponsors of the 2002 Super Bowl, okay? Here's what's incredible. If you put $1,000 total and you were to short all these stocks, meaning play the downside essentially, right? You would be a billionaire today with a B. $1,000 turned into $1 billion. Largest sponsors of the 2022 Super Bowl, right? It's all the crazy tech stocks. Sort of interesting, right? Just sort of further proving the same thing. So one more time for me. So when we look at perspective a little bit about bull markets and bear markets, just very simply, going back to the early 1900s, you're going to notice in blue, and I know you can't see these numbers real well, but all those blue bars are the bull markets, okay? The orange is the bear markets. And what's interesting is the average bull market lasts about 4.4 years, and your average return is about 155.7%, it says, okay? The average bear market is much shorter, 11.1 months, so just under a year, but you're down about 31.7%. It's more violent, and you'll see kind of the gray areas in here. Those are all the quote unquote recessions within those bear markets. And what this really gives us a feel of is that, remember, the S&P still returned basically almost 14% annually over that time frame, just being consistently invested. And this is where the timing piece gets to be so difficult. We're like, hey, we're reading a lot about recessions. When is the recession coming? When should we get out? Should we get out? Some of you may have those questions right now. But this is why we try to stay fairly stable with our investment philosophies over time. We'll shifting between. Your Compass Group is taking really good care of that. But it's a good perspective because it tells you, again, you bet against the US, right? You tend to lose. One more for me. So this puts this in perspective once again. Any single day in the market since this inception of the S&P, any given day you're in, you have about a 53% chance of a positive return. Okay. We fast forward to a 1-year time frame. Any 1-year time frame, you've got about about 75 to 80% chance of a positive return. You move all the way out to a 10-year period, and you basically have about a 96, 97% chance of a positive return, right? Just reiterating kind of that same point a little bit. Yeah, go ahead. So I want to end with this and then open it up to questions, because I know a lot of you may have some questions. I'm going to end with a poem. I didn't think I was ever going to be a poet up here on stage studying economics, but here we are. But I think it does the best job of giving you perspective that I've ever seen. I think you guys will love this. Okay, so it's entitled The Worst Day Ever. And there's a gal named Cheney Gorkin who was in high school out in Brooklyn. Okay, she was about 16 to 17 at the time. And she's in her English class, and you have to submit a poem. So she wrote this poem. What's interesting about it, though, she won. She got obviously an A in the class, but then her instructor, her teacher, thought it was so good, she wanted her to put it to compete in the poetry competition as well, the national poetry competition. She won at 16 years old, which is unbelievable to me. But it kind of fizzled after that. And then one day, someone found in a London bar of all places, this poem was posted on the wall. Somebody took a snapshot of it, and it went viral after that. It became sort of popular, right? So I'm going to read this poem to you. Let me know what you guys think. So, The Worst Day Ever, what a title. Today was the absolute worst day ever. And don't try to convince me that there's something good in every day, because when you take a closer look, this would be a pretty evil place. Even if some goodness does shine through once in a while, satisfaction and happiness don't last. And it's not true that it's all in the mind and heart, because true happiness can be attained only if one's surroundings are good. It's not true that good exists. I'm sure you can agree that the reality creates my attitude. It's all beyond my control, and you'll never in a million years hear me say today was a very good day. Man, that's depressing. How in the heck did she win with that? All right. Must be some lyrical, form or something like that. But I'm going to read this one more time. But this time, I'm going to start from the very bottom. I'm going to work my way up, okay? Today was a very good day, and you'll never in a million years hear me say it's all beyond my control. My attitude creates the reality. I'm sure you can agree that it's not true that good exists only if one's surroundings are good. True happiness can be attained because it's all in the mind and heart, and it's not true that satisfaction and happiness don't last. Some goodness does shine through once in a while, even if this would be a pretty evil place, because when you take a closer look, there's something good in every day. And don't try to convince me today was the absolute worst day ever. Pretty good, right? So let's have some perspective, take some step back. This could be a crazy year again this year. We want to make sure we take a step back and understand some of the things we talked about, the long-term investing philosophy. And remember, you bet against the US, you tend to lose, right? Thank you very much. Really appreciate it. So Steve, I don't know if you guys wanted to open it up maybe to some questions, or I'll let you kind of take it from here.
I'll bring the microphone by. Anybody who has a question, raise your hand. All right, got a question over here.
When you said the GDP went from 17 million to 20 million trillion, did you account for the inflation in that number? So really it was 18, or how does that inflation number work into that 20? Because that's kind of a false number compared to your 17.
So it is inflation adjusted, that number. Because if you think about, I've got a great slide that shows you the depreciation of the dollar as essentially over the last 50 to 60 years. So you have, that's what they call real GDP, right? Versus nominal. Nominal GDP is pre-inflation. A real GDP is after inflation. It's inflation adjusted. So we always show real inflation. So yeah, good question. Any follow-up to that? Answers everything good. Anything else? Shock and awe.
Caleb, did we have any come in online? All right.
I'm not really sure how to ask this, but when you were saying, what Warren Buffett had said about if you bet on America, you will lose. Well, I think a lot of bet against, right. So I'm on a lot of social media and I hear a lot about crypto and I hear about all the losses and then I hear all these billionaires selling all this stuff and now they're different markets like the Japanese market and all this different stuff. Can you help me understand that in a different perspective than just reading it on social media? Because I'm confused.
Thank you.
Good question. So it's first, I think, important to understand when certain assets do well, right? And so as an example, the last 10 years, I think one of the one undefeated rule of investing is don't fight the Fed. What the Federal Reserve is doing, they're trying to do to the economy, don't fight. So what we got the last decade plus is very easy monetary policy. What's that mean? To borrow was basically zero, right? Rates were at zero. So you can go out and borrow money very inexpensively. And they also did what was called QE and beyond, right? All the money printing and all the things I talked about over that period of time. Those are all very, very supportive of growth and growth assets. Why? Because if you're a technology company, you have to invest a lot of money, right? A lot of money in research and development to get that growth, to get that special new product, whatever it is, AI, right? To get that result. And so money needs to be relatively cheap. And so people start moving away from, the Procter and Gambles, the kind of the safer, slower moving, Verizon's, AT&T's, those kinds of things, right? When you get into an environment and so how that affects the technology companies is that as Fed decides to become less accommodative, right? They say the opposite. They say, hey, we're going to keep rates higher, right? And we've got inflation that's persistent we want to take care of. They raise rates as high as they can to slow the economy down on purpose. Well, that kind of puts a crunch on a lot of technology companies, including Coinbase, right? Or the cryptocurrency exchanges, which have a pretty high correlation to some of the growth companies. You see remember the NFTs that everybody's buying these rights to like some random picture online and they're making millions of dollars. Things like this start coming out of the woodwork. But as you raise rates, the dead bodies kind of start floating to the surface slowly but surely, right? And in that space in particular, we talked about cryptocurrency, it's been unregulated. And so now you're starting to see more regulation come in as more things have been washed out. I talked about FTX, which obviously went under. That was sort of the first of that. You started seeing some issues across the board worldwide as well, but you're seeing a little bit more of a shift to value. So the interest in overseas could continue if you see higher rates persist for a long period of time and inflation stays higher. However, it just means that essentially the dollar is a little bit weaker and these international companies didn't have quite the run the US companies did. And so people are trying to find value where they can. Where can they find opportunity? Where can they find dividends? Because if I'm not going to get the ultra high growth out of Coinbase and cryptocurrency and Bitcoin and those kinds of things, in lieu of that, where do I find upside? You go back to things that Warren Buffett loves, like dividends and buybacks, right? And great companies with lots of cash that can still grow in that environment. Whereas some of those, high growth tech companies that have nothing but debt, right? Not necessarily the Apples and the Microsofts and those guys, they have a hard time sustaining themselves in this environment. You saw the same thing back in that 2000 through 2002 period, right? The internet boom, right? And then they all kind of collapsed because essentially the same thing happened, right? And they had a hard time persisting, and a lot of those names went out of business. So when you kind of transition from growth to value or vice versa, there's a little bit of a digestion period, right? The market's trying to figure out, are we truly moving a different direction, or should we go back towards the last decade's winners? I would tell you this, in a new bull market, there's typically always new sector leadership and new stock leadership. When you see people chasing, like you've seen more recently, there's 8 companies out there called the FANG Plus. When they start chasing these names, it's the winners from the last decade. That's classic late stage or late bull market action, right? And so, what your team does is looks for, hey, where's the puck moving, right? If we're in this new regime, where do we pivot from there, right? And so they've done a really good job balancing portfolios, done a really good job adding some alternatives, things like that, and dividends. I know they're very focused on dividends. Had a lot of discussions about that. All of those things stabilize portfolios in times of uncertainty like right now. So I don't know if that answers your question. Okay, good.
I don't think I heard you mention anything about foreign policy. So I'm curious as to what you think the war in Ukraine has had on our overall economic outlook.
Yeah, so foreign policy as it relates to wars, because this is a lot like a lot of wars we've had in the past. What it typically causes is a lot of inflation, for one, right? It's part of what exacerbated the supply chain challenges that we've had. I know China's having a very difficult time reopening right now because some of their largest trade partners are struggling economically. Ukraine is one of the biggest bread baskets in the world, right? They ship out a lot of grains and things like that to subsidize specifically to Asia. And I know they have a lot of shortages right now. So you see shortages from that standpoint, but you also tend to see a lot of hard asset prices increase as well, whether it's oil and gas, or in this case, some of the ag products. You're starting to see some cracks behind the surface in some of the metals because both Russia and Ukraine are pretty large developers, especially Russia, of some precious metals used in things like catalytic converters and copper and things of that nature. So put some strain on. And what you see from a foreign policy standpoint is because you see some of this conflict, China, Russia are big metal and mining producers, as well as some of the ag. You know, they use it as a little bit of a political weapon as well, right? So we have this chip war going on with China, which has further made, created issues these last couple of years with supply chains with chips, right? We saw cars sitting around forever. That was a piece of it. It sort of exacerbated those issues. And so there's a little bit of a soft war going on between Russia, China, and the US and the Eastern European or the Western European countries that are kind of playing these restriction games back and forth, right? So there isn't full out war. Full out war can change some things, but as it stands right now, everyone loses, right? I mean, you're seeing it out of China right now. They're having a very hard time growing and getting out of COVID because they had a zero COVID policy for a long time. And so they don't want to be too restrictive with the US as well because their exports are down now and things like that. So it creates some interesting challenges. It's the end consumer who typically ends up losing out of those things. But that's typically how those conflicts go. It's more commodity based and really how it's affected inflation primarily. So now if that were to resolve itself, you'd see globally markets probably would rally, and that would take some strain off supply chain as well. So that would be positive to GDP, both US and overseas. So good question. So do we see a trade war coming with China over this? To a smaller extent, it's already started. Just kind of cracks in the surface. Nothing we saw during the Trump administration. Could it turn into that? Absolutely. Do we see it happening? No. If most countries around the world weren't still trying to come off COVID and deal with the big elephant in the room, which is inflation worldwide, there'd be more levers that these countries could pull. But because most of these countries are just trying to get themselves moving again, right? There's a low likelihood of that at the moment. Is it possible? Certainly possible. We'll see how that develops. But I don't think this current administration, at least in the US, is trying to provoke too much. That's why you just saw our trade minister just went over to China to try to smooth things out for the first time in I don't know, it's been a very long time, maybe a decade, something like that. So they're certainly trying to smooth things over, but if, US is trying to focus on the EV component of it, and China is just trying to get themselves off the mat at the moment. So they've got very, differing views, but we don't see anything changing with trade. But you never know, in 2 years, things change at the elections, that could change quickly as well. But for the next 2 years, you don't see anything. It's hard to tell at the moment, but we're not projecting it at the moment. At least nothing significant. Good question. Yep.
You have to walk away yet. What do you think first of artificial intelligence? And then is that in the belly being digested?
So yeah, so with AI, it's a great question. There's a lot being discussed about it, and I think there's no question that will have an impact on the U.S. economy and growth in the U.S. economy. But for now, it's very specific in just a few companies that are benefiting, right? Especially some of the chip makers like NVIDIA as an easy example, right? That are directly benefiting off of other companies investing in chips and so on and so forth to grow AI in their business. In 5 years from now, do we say it making a big impact? Absolutely. In the next couple of years, most likely not. Again, it takes a lot of investment, a lot of development. It's like very much like you saw during 2000 with the internet age. Most of the dramatic impact didn't come for 5 or 10 years later, right? But a lot of investment, a lot of attention was had at 2000, like, hey, complete game changer, like it was going to happen tomorrow. And again, no question, AI will probably have a pretty significant impact. Some industries a lot more than others, though, clearly. With some marketing, well, so as an example with restaurants, with some of their marketing, some of the AI marketing is one that should be impacted quite a bit. Transportation, creating efficiencies in transportation, some of those companies should benefit quite a bit. Obviously, technology companies will utilize it the most. Any of the data gatherers within the technology space could be a game changer. You're seeing it affect potentially the insurance companies again, and focusing on the right types of clients that tend to be a little more sticky. Those are the primary sectors right now. I'm trying to think if there's anything else jumping out. Less effect on material companies and industrial companies. Robotics should have a big impact on the industrials, but less so on those spaces. Energy, kind of the same thing, less impact on a sector like that. Staples, a little bit less impact there. It's gonna be more discretionary technology type names for the most part. Yep. Good question. A lot of good ones. This is great. Anything else? Yeah.
I'm hearing a term that I think is called Fed now. Right? What is it? What's it mean?
Have you heard much about this, Steve? I don't know that I've heard that term much.
The questions I have been getting about the Fed are with regard to the digital currency. We can be getting questions about that. And there's a lot of conspiracy theory around that whole idea. But does First Trust have an opinion about central bank digital currency?
Yeah, so as far as the Fed now, we'll have to take a quick look and get back to you at that exact term. But as it relates to cryptocurrency, because that was sort of the big wave a couple of years ago, right? We believe that because people are thinking, is Bitcoin going to take over as the world currency, right? Is everything going from the dollar, right, to Bitcoin? And the answer is no. And the reason why it isn't is because at the end of the day, the Fed needs control of monetary policy, right? The ability to print money or, again, shrink the balance sheet, do things like that to get us out of recessions, COVID crisis, things like that. And so what the IRS will do is one of two things. They'll either create their own version of the cryptocurrency that you have to pay in, right, via your taxes, or they'll just say, hey, I don't care if you want to use Bitcoin, but you still have to pay us in US dollars. At the end of the day, they can always control that, right? Because they're the ones collecting the taxes. And by law, you have to pay your taxes. And so at the end of the day, even if cryptocurrencies really take over as a replacement, it won't ever be a full replacement because the Fed still has complete control over that component. So it's an interesting discussion we've had. We've done several write-ups on that exact question over the last couple of years because it came up so much. But now, as you're seeing, now that we're seeing a little bit more volatility, there hasn't been the stability, right? Companies are going out of business. But now we're seeing that it's unregulated, so that creates some issues. So there's a lot of things to work out in the meantime within the crypto space before that ever becomes a full replacement currency. And if you look at it, it's sort of interesting. It really hasn't been that highly correlated to the dollar. Usually when the dollar goes up, you'd think Bitcoin would do the same thing, or vice versa. When it goes down, it would be a replacement. But it's really been kind of a low volatility play. As volatility has stayed very low in the US, Bitcoin has done very well. Same thing with growth. As volatility spikes, it's done the inverse, right? It's done very, very poorly. Seeing rotations like last year is an example where vol was very high. So that's kind of our take on crypto.
I'll add also on crypto, Bitcoin, it was thought that it would be a great inflation hedge. It collapsed during the inflation. All right, I think that's the end of
The Fed now is kind of their answer to what's happened in the private sector. So the money can move instantaneously between two parties. And I don't know if they intend, I didn't read enough to know if they intend to keep that mainly institutional or if that is going to be available to private citizens as well. But that's what the general term means. So I do have a question for you. So read this week, again, I think in the journal about China is very worried about deflation kicking in. If China headed into deflationary times, maybe not as long as what Japan dealt with, but a long period of time, what's the approximate impact? Question number one. Question number two, the whole EV movement with electric cars. Again, I do a lot of reading about this. The battery thing seems to be unsustainable based on what I read again in the journal, and especially the environmental impact to harvesting the nickel necessary to make one EV car. Leading researchers are already shifting to hydrogen power to try to invest a lot of research dollars into that. I'm curious as to what First Trust sees out on the cutting edge with energy like that.
Well, let me start with the question on China real quick. So what's interesting is that during this COVID period, China is the only country in the world at the moment that doesn't have any inflation, right? In fact, you go outside of the US, you see some pretty extreme inflation outside of Europe and outside of the US. Places like Brazil, Argentina, some extremely high inflation rates. But all those countries, excluding China, did a tremendous amount of printing and bailouts. China did not during that COVID period. They didn't shoot all the bullets in their gun, if you want to put it that way. US and Europe has kind of used most of their bullets in their gun at this point. There's not a lot left. China does not. And so are they worried about inflation picking up? Potentially, right? But the good news about that situation is that they still have a lot of upward mobility in monetary policy, meaning they can still print a lot of money. They have a lot of ways to still support real estate and loosen up a lot of the regulations in China as well before they worry about runaway inflation. Unless you, again, what creates the inflation is the printing of the money. That money then is given to the residents, right? The people that live in China, and then they would go out and spend it, driving those prices up. That's what's creating that inflation. It's the velocity of money. Well, if they haven't done all that printing, at least right now, then there's no concern. The concern would be if they really try to come in and their economy really starts to tank for some reason, just can't get off the mat, and they have to print a lot of money, right? Depending on how much they spend or how much they print, that could cause some additional inflation. But they're really nowhere close to that at the moment. It's ticking up slightly, but again, it's coming from basically nothing at this point, right? Where we're coming off at 10%, which is pretty incredible, right? Double digits. And you're seeing really high double digits in many other countries across the world. So for the time being, China is not overly worried about inflation. They're mostly worried about getting their economy going after a long extended zero COVID policy, right? That they just opened up, very end of last year. I think it was October, November of last year. They just opened things back up. So it was long and extended. As far as the EV goes, absolutely. The number one primary issue is that, remember, over the last decade, commodities haven't done great. They've been spending a lot of money, but every time we go into a recession or something like that, like we saw in 01, 02 or 08, 09 and beyond, they're left with all this additional debt because you got to buy new smelters, right? New mines, all those things are hard to come by. As an example, copper, okay? Of the 10 largest mines in the world, okay, 9 of them were started over a century ago, okay? Only one was started within the last century. So you can't just like turn the spigot on in copper and just make more copper, right? It takes you a full decade to bring on a new copper mine. Pretty incredible, with a lot of investment along the way. And remember, copper is one of the primary components that goes into building out our grid. So one of the biggest issues isn't just, are we making enough batteries, but man, how do we upgrade this grid to be able to handle all these EV cars? Because remember, we saw what happened in California, right? Grid shut down because it was overloaded. There was too many cars, and so a bunch of these EV cars were certainly stranded. The other challenge is, again, these material companies have continued to shrink their supply because the demand has been so low. All the money has gone towards the growth companies, the technology companies, and so forth. And so they've shrunk down. So their supply is just a fraction of what you've seen overseas. Here's the other challenge. 95% of all precious metals, okay, remember, precious metals are what go into EV batteries, okay? 95% are either mined or controlled by the Chinese, okay? So as an example, you look at windmills or EV batteries, 80% of all EV batteries come directly out of China right now worldwide. They still dominate that market. And so the US is trying right now to invest a lot of money in that vertical integration, which means the mining, the processing, and then the final product. And the final product for solar, wind, EVs, and high-end guided missiles for the military is these magnets, these high-end magnets. That's what you make with all this stuff, right? And there's massive shortages. There's one company in the US that's building that up, that's gotten a pretty big contract and some additional money from the government. But that's one lever that China can use pretty significantly, right? Which is part of why you see this chip war. So yeah, massive shortage. They just did a big export cutoff in germanium and gallium, which are two of the main components within EV batteries as well, for this exact reason. So yeah, they have a high percentage of the control in that space. So no question, that'll be interesting to see how we navigate that space, whether we go more the hydrogen route, but again, more dollars, more investments, right? When we spend all this time and energy on the EV side. This is why Tesla, by the way, went out and bought a lithium mine. They have an entire mine, right? When's the last time you see car companies, they're buying out mines? That's what you're going to start seeing, just so they can shore up their supply chain of certain metals in this space. Pretty incredible. Great couple questions. Came prepared. I like it.
Caleb, how are we on time? All right. Well, thanks to all of you for coming out today. If there are other questions, of course, we encourage you to hang around and talk to your advisor or one of us. And again, thank you for your business. We truly appreciate it, and have a great rest of your day.